Welcome back. Well, as promised, let's get chatting with the management of Metropolis Healthcare. We have Mr. Surendran, the CEO of the company, who joins us on the show. Hi, sir. Morning, and thanks a lot for joining in. Well, before we get to the business dynamics, give us some clarification. Why did Ameera Shah step down from the MD position? If you could, fill us in with a quick comment on that.
Good morning and good morning to your viewers. Now let me clarify, Ameera has not stepped down. Actually, Ameera has stepped up as the chairperson of the company. Dr. Shah, who is the founder and chairperson, has moved into the chairman emeritus role. So Ameera is assuming a higher responsibility as the, executive chairperson of the company.
Okay, so no worries over there. You're saying it's a step up rather than a step down. We got that. So off MD position into the executive chairperson role. So thanks for clearing that, Mr. Surendran. Let's focus on your business aspects then. The wellness testing as well as specialized testing. Well, that's seen a good growth in the past year. And now I think specialized tests, they contribute closer to around 36%. And if I got that number right, the premium wellness is approximately mid-teens, around 15% odd. What's the growth trajectory on both these two segments that you're working with for FY25?
Yeah. So if you look at our quarter four results, we had a strong quarter. We had core revenues grew by about 15%. And the core revenues actually growth is fueled by both wellness as well as specialty segments. Wellness segment, the premium wellness segment grew by about 22% year-on-year basis. And our specialty grew by 16.5% on a year-on-year basis. So we see both the segments, specialty as well as wellness, further making it better during the year and going to fuel the growth in the year to come.
Okay, so that is the specialty in the wellness business. Mr. Surendran, good morning. And now that you've assumed, the role as CEO, I want to understand what is the guidance in terms of the mid-teens growth. Earlier, that was mid-teens growth is something that you've been talking about. So what is the way forward now? How much will you get from mature markets? How much from new markets? What is the overall volume growth that we're looking at over FY25 and 26?
Okay, let me explain this. We had a 15% core revenue growth in the last quarter, right? And out of the 15%, 7.5% growth has come from the volume growth and 7.5% has come from the realization, right? And all our focus market, which are our key markets, 5-6 key markets, they grew almost about 12-13%. And our new market, which is the tier 2, tier 3 towns, and grown by more than 24% or so. So the growth is largely coming from the newer market that we are entering into, and whereas we are holding our key markets. Now, Mumbai is our, what you call the strong market, flagship market. Mumbai grew by 20%. In fact, entire Maharashtra, the growth trajectory is very, very exciting and very, very, promising in the days to come. So it's actually a portfolio play. We will be growing both in our focus market, our seeding markets, and our new markets as well. It will be going to be a portfolio play, and all the markets must be keep kicking in the days to come for us.
So given that you're looking at newer markets, the mature markets as well, is it fair to assume that you can further build on to these margins? Your estimated margins are around 25.5 to 26%. But are there any more triggers or levers to build on to this?
So 25.5% in quarter four was the best quarter for us in the last year, right? And going forward, we definitely see these margins going up by a 0.5 to 1% better. See, please remember, every year we are adding around 24 odd labs. Last year we added 24 labs. This year we are adding another 24 labs. This actually leads into dilution of the margin by about a percentage. So that is going to continue for 1 or 2 more years because we will be keep adding newer and newer labs, particularly in the regions of North and East, where we wanted to geographically expand, So that growth will continue and that laboratory expansion will continue. And also the center expansion will continue. We are added 550 centers last year. And this year also, I see the numbers going up to 500 to 600 numbers in terms of the center expansion. So this will definitely give a little bit of dilution in the margin for a short period of time. But this is a good thing to do when you look at a long-term basis. We are really establishing good quality diagnosis across the country, across the geographies in India. So that's a good investment to make. But having said that, we are looking at productivity improvement opportunities within the organization. And maybe our digital assets that we have already invested in will getting further stronger. and which will lead to productivity improvement in the year to come. So maybe 1% plus EBITDA margins from what we left at Q4 is going to be the guidance in the year to come.
Mr. Chamal Kuttal, good morning, Prashant here. Now, in your results, as part of the results, you highlighted that the discount percentages in the B2B segment are lower in FY24 as compared to FY23.
Right.
So it kind of indicates a reduction in competitive intensity. Can you sort of say that is the case for the overall business as well, in terms of discounting, etc.?
So, Prashant, I would not say that the reduction in discount is purely on the basis of lowering the competitive intensity alone, but we have made some very good investments in the B2B segment. We thought, it's not necessarily the price which will play out there. We concentrate on the top end of the B2B segment rather than, going after the long tail of the B2B segment that we had. And on the top end of the B2B, we made some investments in terms of improving their experience. We invested on a B2B portal, the partner portal. We invested on some relationship managers, and we have made some basic fundamental changes in the way we operate in the B2B segment. So that also helped us to focus on the top percentage or top 20% of the clientele, and which helped us to reduce the discounting and stay stable there. So going forward, our focus will be on the top end of the B2B clients on the B2B segment and not so much on the long tail that we have.
Okay, all right. You're in this mid-teens growth, sir, as you mentioned, for the partial specialized test and premium wellness business, well, it grew very well. But on that base, what are you expecting? Last year it was 16 to 22%, as you told us. But for FY25, what are you penciling in for both these two segments?
Okay, let me tell you, see, wellness is 15% of my total portfolio.
Yes.
And I clearly see there's a good headroom of 4 to 5% more in the next couple of years. So wellness awareness in the entire country is increasing. People want to go and do their health checkups on a timely basis. And we are also trying to engage with our customer on a 360-degree basis on the channels, like, for example, on our centers, then they walk in, on the digital channels, and also through the life cycle management, we reach out to the customer. So we are getting good response on the wellness segment. I clearly see the wellness segment taking a growth of 20 to 25% year-on-year basis and helping us to make this portfolio as big as 18-20% in the next 2 to 3 years time. And similarly, on the specialty, we are making a lot of investments, on the high quality, high-end test, and in terms of, let's say, genomics and molecular biology, etc. So we're making some investments. And also we are adding the test menu on all the therapeutic areas like transplants, neurology, nephrology, oncology. We're making a lot of investments. We're also making our sales force good enough to go and meet up with the specialized doctors. So all this put together, I'm quite optimistic about a good positive movement on the overall specialty segment. So currently it's going about 16%. I would definitely want this to be in the range of 20% going forward.
Got it. So we've got both those two out of the way. 20% for specialty, and wellness segment could grow by nearly around 22 to 25%. Mr. Surendran, if competitive intensity is fading a little bit, it could give an opportunity to buy some of these smaller size companies, and you have some cash balance as well. Is inorganic growth something that you're actively looking at, and could we hear about something in the first half of the fiscal?
Yes. So, yes, you are right. The pricing competitiveness is really coming down because everybody is realizing that it's better to stay prudent in this industry. And hence, we really clearly see some amount of stability in the last 12 months in terms of pricing stability. We are definitely looking at some acquisitions, right? Which will, we basically look at acquisition from two lenses. The first lens is, can I get some good acquisition which will complement my geography expansion, particularly on the north and east part of the country? If we get some good acquisition, good assets, we'll definitely look at it. And also the other lens we're looking at it is the skill set in terms of complementing in terms of skill set. If I get some good, high quality, high specialized areas of diagnosis assets available in the country, we will look at it. So these are two lenses that we are looking at. Our team is definitely doing all kind of due diligence, and in the event we come across a good asset, 1 or 2 bolt-on acquisition, definitely on the cards during this year.
So if and when you close these acquisitions or assets, right, you've earlier said that you won't look at taking debt at beyond 2.5 times EBITDA. Just want to confirm that. Will most of these assets be acquired through internal accruals, or are you planning to take on any debt? If yes, how much?
See, this all depend upon what is going to be the size of the asset. right? And if the size of the asset is smaller, definitely we have internal cash accruals. We'll use the cash available with us. But if the asset is relatively bigger, then we will need to look at other avenues like a debt or maybe swapping the shares. So we will look at all the options and depending upon the size of the asset, we will take a call when it comes closer to the acquisition.
All right. So you're saying when you talk about swapping shares, the acquisition that you're looking at could be a listed company as well?
Not really. I would not like to comment about it, before it really get matured about it. So we are thinking about some. Basically, see, we have mentioned in the past also, we are looking at bolt-on acquisitions. So you must read it from that lens. So bolt-on acquisition is our strategy. Maybe a couple of bolt-on acquisition is what really we are focusing upon.
Okay. Finally, you earlier said that the margins may see some pressure because of the new lab rollouts, but you also spoke about some cost optimization which could offset that. Can you tell us what is the cost optimization and what would this margin pressure be? I mean, just net, what would the impact be on margins?
See, pre-COVID, we used to run on a 26 to 27% EBITDA, and I think that's a decent EBITDA in this industry. And we closed last quarter with 25.5%. So our endeavor is to bring closer to the pre-COVID EBITDA, in the year, this year or maybe by the end of next year. We want to definitely bring it to the pre-COVID levels of EBITDA. Now, the levers available here are basically 2-3 things. One, of course, is we want to expand our B2C business. B2C business comes with relatively higher margin. So, if we are expanding the centers, we are expanding the labs. I mean, we are also, amplifying our contact to the specialty doctors. All this should help us in terms of improving the B2C business, which is definitely going to help us improve the margin. And secondly, we have done a lot of lot of investment on the digital assets, improving the technology space. And that's going to give us a lot of productivity enhancement in the days to come. And this should really help us to reduce some kind of cost. And we are also looking at the whole material productivity because good negotiation with the vendors and using some best practices, benchmark practices across the company, we should be able to reduce some level of cost on the material. So all this put together, we will definitely see some improvements in the margin. But like I said, when you're expanding 25-30 labs every year, it will have a dilution of a margin, maybe about a 1% for till the time we keep expanding in the labs. And I see this year also we're expanding labs in the same proportion. Maybe later, the lab expansion will slow down a little bit, and then you will see further improvisation on the margins.
All right, we leave it there, sir. Thanks very much for your time. And, we'll speak once that acquisition happens or other developments as you outlined. Appreciate you sort of coming on.